Good afternoon. It's 4 o'clock. It's Tuesday afternoon. I want to thank everybody for jumping on the Barometer Readings webcast. We are here now 2/3 of the way through October. Go Jays! I'm gonna put my Jays shirt on today. I got a good fortune to go to the game last night. Boy, that was fun. Um, but I guess I got cut up this afternoon. You didn't get it on. Lots to talk about today. In many ways, it's been onward for the markets. Most of the key themes trucking along. Was some volatility on Friday and today in some of the commodities. We're going to talk a little bit about that. We're going to focus more on that than other things today. Had a few calls and discussions with folks on that today. So as usual, what I'd like to do is start from the top. It's a beautiful sunny day here. I got sun coming in the window, and you got to remember there's good days and bad days. If we take a look at the long-term picture for the U.S. stock market, it's been marching its way higher over the last several years. If I look at the S&P 500 on the weeklies, we've been kind of marching higher since April. And again, in the month of October, the S&P is up another 0.87 of 1%. If we look at the daily chart, it's been pretty orderly, although about 7 or 8 days ago, we got the shot down on Trump's comments on 100% tariffs for China. He has since walked that back, thinking that that would be very difficult to put those kinds of tariffs on. Market has come back toward the highs, not yet made a new high, not quite back yet in the long-term channel. So we're certainly keeping an eye on that. There's been some strong parts of the market and certainly some weaker ones. If I look at the QQQ, the NASDAQ 100, it's a similar picture. It's been working its way through this channel and has maintained it. It's trading about the 200, the 50-day, the 8-day, and the 21-day moving average. So from an index perspective, U.S. stock markets are performing fine. We talked a little bit about the Russell 2000 last week, and it has lagged. It's lagged over the last 4 years. But it is relevant that we have been able to trade above and stay above the highs from November of 2024 and the highs from December of 2021 before the 2022 bear market. So that's encouraging. Because the Russell 2000, of course, is made up of mid-sized companies, a lot of them more domestically focused in the U.S. There's a lot of financial services companies in there, regional banks in particular, also some materials companies. So something just to keep an eye on. Looking outside the U.S., the beat goes on for global securities. International stocks, which are defined as developed market equities, ex-U.S., month by month have been marching their way higher, and October is no exception. We're not trading at the highs, but we're darn close. If we look at the Eurozone, it's a similar picture. 1, 2, 3, 4, 5, 6, 7 months having made a new high. I had a conversation earlier today with an advisor who's considering adding international equities to his portfolios for his clients. We talked a little bit about the fund that we're running, and his concern was, well, boy, it's been really great for global markets over the last few months. Am I too late? And all you really have to do is look at these charts to see just how long the bear market was, in this case, 16 years, and how short the beginning of this new move is. And it even puts it more into context when you look at the Japanese stock market. Yes, since the Japanese market made a new high, it's up 28%. And that's sure a great start. Just keep in mind the last structural bull market was up 2,896% over just about 20 years. So when a market has not made progress for an extended period of time, it's not as though companies aren't improving through that period. Arguably, Japanese stocks are incredibly expensive, and they made up 60% of the total capitalization of the world markets in 1989. Today, they are considerably cheaper. They have been restructured as mandated by the Japanese Stock Exchange in 2023. They've been unwinding cross ownership wages have started to rise in Japan for the first time in 25 years. And some of the companies and sectors that make up the Japanese market are starting to catch a tailwind. So, yes, up 28%. But when you put things in context, it's very, very early. Asia as a whole continues to march its way higher. Shanghai, once again, this month, working its way higher. You can see in the month of September, it pulled back, but then closed toward the highs. In the month of October, it pulled back and now is headed toward the last week of the month toward highs. So these are early stage and resilient markets. And of course, they can have short term corrections. But I just want to highlight how early we are in positioning in international stocks. We talk to advisors all day long, we talk to family offices, and many of them are considering how they might participate, but virtually none of them have significant weights in their portfolios. So it's encouraging to know that there's a lot of money that can come in behind us lifting prices higher. If I look at some of the frontier markets like Africa, well, tough day today, down 3% for the AFK. That would be on the back of some weaker gold prices. But relative strength has been marching its way higher, and bull markets are pocked by short, sharp corrections. Peru, even though there's a pullback in gold, we pulled back some of the gains from the month of October. We're still sitting virtually where we were at the highs at the end of September. And the TSX is the same picture. TSX has been marching higher over the last 18 months, confounding a lot of our clients for sure as to why it is the Canadian stock market's doing so well while the Canadian economy is languishing. Just keep in mind how many companies are in the TSX that are important companies that are really not dependent on the Canadian economy for their bread and butter. A lot of global materials companies, resource companies, industrial companies, and really not focused in the consumer economy. So whether we're looking at the MSCI All World versus the equal weight S&P, very clearly have made a turn, or the TSX versus the S&P, things getting better. So since we launched the Global Fund, December 29th, 23, the equal weight S&P is up 31% total return, including dividends. The MSCI All World in Canadian dollars up 45, and the Barometer Global Fund now up just about 56% over the period. So doing sort of exactly what we had hoped it would do. Now I put this chart up earlier in the year. How when you track rolling 5-year monthly returns for US equities versus international equities, when US equity returns relative to international start to fall, it tends to go on for a long time. And again, from another measure, this is really the only change that we've seen so far. So the US dollar is just in the process of coming down into negative relative performance. And we've only just begun this decline that literally could last a decade. So something to keep in mind. Doesn't mean US stocks have to fall. It means that international stocks are likely to outperform. In fixed income, long-term interest rates have continued to be sticky. Since 2020, we've seen a series of higher lows, and we continue to have those. Certainly, yields have come down a little bit. We've come down from about 4.95 to 4.58, but yields continue to be an uptrend. The moving average is moving higher, and even the 200-month moving average for the first time since 1981 is trending higher. That's a great measure of very long-term trend. When we look at the long-term treasury bond, the TLT, certainly it's seen some improvement, but again, still seeing a series of lower highs. We'll watch that closely for some sign of change. So in the background, in the core of all the portfolios, as most people know, we've been focusing on dividend growth. If the bond market is concerned that the longer term picture for interest rates is higher and the inflation could be stickier, we want to make sure that we have a rising stream of income for the income component in portfolios. Fixed income doesn't tend to do well if long-term rates trend higher over time. And equity investors appear to agree because dividend growth stocks continue to outperform high dividend paying stocks that tend to have very little growth. So we think rising stream of income attractive to offset a rising cost of living. And again, we think this is relatively early days. In the world of commodities, commodities have been marching their way month by month since globally central banks started to cut rates. We've seen some pullback here in the course of this month. So now we haven't broken the lows from September. At this point, you see pullbacks over the course of a month, but we're going to examine that a little bit closer. Here's the price of gold. And what we're looking at is a daily chart. And this goes back to March of 2024. Really, since gold started its uptrend. And you can see it's been marching higher. And especially since August, almost daily, marking its way higher, staying above the very shortest of moving average, the 8-day moving average. But today, we're down 5.5%. Now look, short, sharp corrections in a bull market, that is true. But we do like to watch when share price starts to go parabolic, because parabolic charts don't tend to correct by going sideways. So one of the things that we watched is how far gold is getting stretched above the long-term moving average to assess it. Now on a monthly chart, look, everything's great. This green bar is the month of September. This is the month of October. We've given up, I don't know, roughly half of what gold has gained in the month of October. Not such a big deal. So I'll tell you what we're watching here. We're watching the fact that in a gold bull market, and here's an example, 2003 through 2011, things don't go straight higher. You have a series of steps. In the bull market that started in 2004, the first leg got to 77% above the 200-week smooth moving average of price, which means it extended away from the trend. And what resulted? Ultimately, you had a correction that went on for about 6 months. And it was about a 25% correction. So we know at some point we're going to correct. Now, this is one example of a gold bull market that came after a gold bear market. In the case of the current bull market, we got to just about 85% above the 200-week moving average. So that's notable. It's comparable to what happened in the first leg of the bull market after 2000. If we compare to the bull market of the 1970s, after the bear market that ended in 1972, the first major rally ended at 140% above the long-term moving average. And you can see in both of them, they had 3 distinct rallies and corrections. Rally, correction, rally. Go back to the previous chart. Rally, correction, rally, correction, rally. So I don't know whether we can compare this to the early 2000s. My guess is, given the change in inflation metrics, we are probably more like the 1970s. But we have to understand the range of outcomes. So given the fact that we have seen things pull back, you got to take note. Now let's look at silver. This is the recent move in the price of silver, 82% above the 200-week moving average. The first move in the 2000s went to 75% above. So again, we've slightly exceeded that gain. If you go back to the first move in the 1970s, we got to 230% above, or almost 3 times the extension that we've seen so far. Now, one thing we do know, we're in a long-term bull market. This is likely to go on a long time. Whether we correct here or we correct after it doubles from here, we don't know the answer. So we have to manage the position. You have to manage the position size. You have to watch for change. The long-term picture, gold relative to QQQ, or gold relative to the NASDAQ, turned higher in 2000 as U.S. stocks started to run out of gas and then outperformed for a decade. We've recently made a turn over the last 18 months, and this is up to today. Pretty clearly, this trend looks like it's in place. So it's something to keep in mind. Outside of gold, platinum pulled back as well. It's down about 6% today. Copper pulled back. It was down like 2% today. But all of these charts, these long-term structures, support the fact that it's the very beginning of a bull market, not the end. And we have to live with a little bit of volatility from time to time. They're called cyclical for a reason. We have to be prepared for that, which means we have to manage our position side on energy. Energy continues to be sloppy, and so it's hard to add a lot of weight here. This is WTI. We keep in mind time of year is that you tend to have seasonality that's weak up to this point. And certainly there is optimism around some of the resolution of conflict in the Middle East, and that could be having a near-term impact on oil prices. We're going to put our time spent on the individual equities as opposed to the oil itself. So look, our job is to pick our spots. Our job is to spend a lot of our time understanding what are the key structural backdrops, which asset classes have performed well, which sectors we want to focus on, and then we find securities to express our view. And ideally, we want to focus in parts of the market where we're seeing expanding breadth. So over time, more and more stocks are participating in the rally. And then we want to express the view, finding high quality securities, companies that meet our business tests, that are technically sound in parts of the market that are showing expanding breadth, and that's where the portfolio should live. Importantly, we're always watching for signs of deterioration in breadth. And that could come at the sector level, it could come at the geographic level, it could come at the asset class level. But this is something that's important as part of our process. We do it every day. We track breadth against 300 universes of securities to help us to know where we are safe to be putting on new positions, where we want to make sure we're keeping our stop losses tight, and where we want to stop putting any new positions on. So selling strategy is probably the most important thing when it comes to investing. And it's something that we spend a lot of time on. On our breadth models, percent of stocks in uptrends in the NYSE has been weakening a little bit, as we've talked about. We've reduced our exposure to US stock markets in our equity portfolio to about 30%, which is a far cry from where it was. Breadth in both Canada and for international stocks continues to be strong. The short-term indicators are mixed. Look, we don't have to be everywhere. Our job is to find leadership, keep testing it, look for change, try and recognize when something's changing and be prepared to do something about it. So let's just talk quickly at a sector level. We're going to talk a little bit about some of the commodity stocks because I think people are interested today. On the side of financials continue to truck along. The large banks are performing well, in particular the investment banks. We talked about regional banks last week, which we own none of. They are seeing maybe some concern around credit, which is something to keep in mind. European banks also relatively early days in the bull market. From an industrials perspective, industrials have had a great week. So we're now basically trading at new highs in the industrial sector, both in the US and global industrials. Now let's talk about precious metals. So this is the GDX ETF. It's an ETF that owns a basket of senior producing gold and silver companies. This was the picture that we looked at last week. And we talked about the fact that, the group is up about 80% since it broke out to new highs. And if we look at it as of today, since the beginning of the year, the GDX is up 152%. So nothing goes straight higher. As far as its relative position against the 200-week moving average, it's got to 68% above. Excuse me. And this is the price action over the past week, which really is Friday and Monday. So we still remain above all moving averages, but that is a reversal, making a new high and then breaking the low from the week before, and in fact, the week before that. So this morning across the equity portfolios, we reduced our gold equity exposure by a half. And now we'll see what happens. The good thing about exiting a position is you can always put it back on if the technical picture reemerges. And I'm not saying that the technical picture is broken, but we've watched these stocks rally. We've watched the gains that we've made, and we want to make sure we don't give them back. Now, if I go back and look at what happened in 2006, ultimately, stocks did correct back toward the 50-day moving average, which would be down around $60, currently $72. So there is room that these could correct. It could be a short-term correction. We'll have to see. But the net of it is, we don't think these are overly owned. Number of units outstanding in the GDX has been falling, which means that in general, people have been redeeming as opposed to purchasing. And when we look at the net daily purchases and redemptions, there have been lots of purchases over the last 2 days, but in general, over the course of the past year, it's generally been redemption. So we think that a large part of the buying in precious metals has been central banks and individual investors, but we don't think that this is a crowded trade at this point. Outside of gold, the copper producers pulled back today as well, down about 5%. Again, not at any risk of breaching the monthly bar from September. So yeah, we've given up some of October's gains. Uranium producers are the same. They were down about 6% as well. And if you look at the metals and miners ETF XME, it was down 6% as well. So things are correcting. Want to keep in mind the relative position from the beginning of the bull market. We're only 4 months in, and these can go a long way. On energy, energy just continues to march sideways in this range. So looking at breadth, on the 6th of October, the average sector had 51% of stocks in uptrends, roughly 1 and 2. Bull markets don't tend to end until you get 60, 70, or 75% of stocks in uptrends. But they do have corrections. On the 13th, the average sector had 47.9% of stocks in uptrends. And as of this week, 47.5. We've had a couple of groups reverse down, savings and loans, which is regional banks. But still, the strongest parts of the market include metals and precious metals, semiconductors, banks and aerospace. Not a lot of change here. And at the left-hand side of the equation, the consumer in general weak, housing, food and beverage, leisure, home builders, auto. So it's a bifurcated market. As far as what the portfolios look like, financials were at a high point, 28% of the portfolio. They're 19, they're down from 21 a month ago. They're still a considerable overweight versus the index. Industrials continue to be about a double the market weight. Materials are at 12%. We increased the copper weight over the last 2 weeks, but we reduced the gold weight. Technology remains an underweight in a relatively crowded trade, although there's some wonderful companies that we own, and we're going to give them the benefit of the doubt. They're about to go through the reporting period. You can see the cash position is a little bit higher, about 10%. Energy has come down from 12% to 8%. We'd like to see that group break out to new highs and follow through. And outside of that, communications we took down a month ago from 10% to 6%. That was on a reduction in the big NASDAQ stocks. And defensives remain a very small part of the portfolio. Utilities 1%, healthcare 1%, consumer discretionary 1%, real estate less than 1%, consumer staples almost 0%. So we have some flexibility. We'd like to think that as seasonally it goes, that the market finishes strong for the year. We think that if there is risk, there's some risk in US stocks, and that's why we've taken our weighting down. When we look at credit, we've noted that there is some risk being priced into private credit public companies like Apollo Group, with Carlyle, and Blackstone. We have no exposure there. If we look at credit spreads, the excess return bond investors are demanding to take corporate bond risk versus government risk has moved very slightly higher. But I mean, to be clear, nowhere near where it was in 2021, nowhere near where it was in COVID, nowhere near where it was in the financial crisis. So it's something that we watch, nothing to talk about here. And then finally, volatility continues to be pretty benign. It was a little higher last week, has moved back into the middle of the range, meaning things have kind of normalized after Trump's comments on trade. And so long as we stay in this range, that would be typical of a structural bull market. So we're back to the start. The S&P is a broadly diversified basket of stocks. There's sectors that are working and there's sectors that are not. I think it's really important that we focus on the groups that are participating. The good news is some of the groups that are participating are smaller groups, and they make a bigger impact in our portfolios than they do in the index. But we're coming into the end of October. The seasonally weak period appears to be over, and we'll take it week by week. Things that were difficult, we're certainly happy to get defensive. And given the run up that we saw in the precious metals, I thought it just made sense to take a little bit of exposure off. We've had a great run. We'll see whether they correct and consolidate or whether they're able to turn around and be off to the races. But that remains to be seen. So with that, if there's any questions, let's take a crack at them. Robert Lindsay, what are your thoughts about Visa, MasterCard, and American Express? Visa and MasterCard have been lagging American Express. Expect Visa and MasterCard to react to earnings. So the only thing that I would say is that the payments companies in general have been lagging. So it's been a space that we have not been so focused on. Amex benefits from some international travel. But let me take that away, Robert, and I'll come back to you with a better answer. Raj Pudwal. Dave, can you comment on Fairfax? I know the insurers and PGR have been weak. Yeah, so that's a fair comment. We talked about Fairfax today. You may remember that about 3 months ago, we said we sold half our position. We have noted that the property and casualty companies have been relatively weak. Fairfax has pulled back a little bit within its trend, still in a pretty clear upward price trend, but relative performance is weak. And as of this morning, I think it was trading weaker, stronger only than 42% of companies in the S&P 500 on the year. So it's something that we're taking a pretty hard look at. It's been a great stock for us in the long term. So, we don't take selling the rest of it lightly. Jerry gave me a nice compliment about being on BNN and asked me to do a little self-promotion next time we go on. Okay. Well, we'll let you know next time we're going on BNN. I do market call about once a month. I get to do the morning show at 9:30 about once a month. And so, yes, we'll send a note out. I made a mistake last week. Somebody made a comment about not receiving our holdings each week. And I was highlighted to me after the fact that we are sent them out on a monthly basis now. Just it takes a lot of organization to get them put together. So we are publishing our holdings once a month. And if you're not on the list to get any of our communications, please reach out, shoot us an email. We'll put you on the list. If you've got questions that we haven't answered here, happy to jump on a call. And let's see if any more questions here. Anonymous, can you be more specific on gold holding reductions? Yeah, we sold half of our Nico, we sold half of our Kinross. I think we sold half of our wheat and precious metals. We had a very large overweight position. And it's not to say that we don't think these are great companies, and it's not to say that we don't think that there's lots of room in this long bull market in front of us. But you have to manage your position size, and it would not be an unusual thing. I'm not saying it's going to happen, not an unusual thing to see the very best gold producers pull back 25 or 30% in a correction. So we just want to be cognizant of that. Okay. Everybody have a great week, and I look forward to talking to you again next week.